Let's say you have your infinite banking policy. There's one thing you got to remember is you're going to have to make a change to that policy, either the whole life policy or the index universal life policy, whichever policy you choose to use for infinite banking. You're not going to want to start investing right away. You're going to want to make sure you make an adjustment to the death benefit of that policy. Now, the reason why you want to make an adjustment to the death benefit within your infinite banking policy is because the death benefit and the savings account are considered one, meaning what you do to the death benefit also impacts the savings account and vice versa. So if you have an infinite banking policy with too much death benefit, the life insurance company is going to use more of your premium to pay for the death benefit, and less of your premium will go into your savings account. Because remember, the infinite banking setup is a life insurance policy with a savings account and a death benefit. They're one and the same. They're one contract. So to maximize your savings, you have to what? Minimize your death benefit. So we're going to want to start our infinite banking policy with as little death benefit as we can get in that policy. We don't want to take a high death benefit of $500,000 or $1 million unless we're investing a significant enough amount into the policy to justify that type of death benefit. If we want a lot of death benefit, we don't want to use our infinite banking policy for that. We can get the death benefit taken care of with our term insurance policy. So let's get into some examples of how this would look, and you'll get to see firsthand how making adjustments to the death benefit would also change how much your savings will grow, as well as the future income that you can remove from the infinite banking setup. We have a client that is a 55-year-old female that is not a smoker. Now, when you go to apply for a life insurance policy, you have to let the life insurance company know if you're a smoker or not. That impacts how much the death benefit portion of the policy will cost. In this example, this client is not a smoker, and we see that the annual investment into this policy is $10,000 per year. And we see that the death benefit, the starting death benefit, is $278,087. Again, notice that we have $10,000 going in and a $278,000 death benefit. But remember what I just told you. I said we want to start with the lowest death benefit possible. Now, look over here. We have same person, same age, but look, in this example, the death benefit is $123,000 for the same $10,000 investment. So you see how we can be putting the same amount of money into the policy, and one policy have a higher death benefit, the other policy have a lower death benefit. And watch this. Let's go back over to the policy with the higher death benefit, because remember, this is an infinite banking policy. So we're doing this not for the death benefit. We're doing this for the accumulation value, the tax-free income later, the ability to borrow from that bank that we built up into the policy. Now look what happens over time with the $278,000 death benefit. Look, we invest $10,000 into the policy. $6,700 of that $10,000 goes into our savings account. The balance, which is about $3,300, goes to the cost of the $278,000 death benefit. You're paying for that death benefit out of the $10,000 premium that you're putting into the policy. So if you're wanting to have more go towards the savings, this is going to be too much death benefit for you. Now look what happens if we reduce the death benefit to the lowest amount possible based on our age and the amount of investment going into the policy. Same person, right? 55-year-old female, standard non-tobacco. $123,000 death benefit here, $10,000 going in per year. And look, our savings, our first year savings goes from $6,700 to what? $8,400. You see how much of a difference that is just the first year. And over time, that difference will become larger and larger and larger as you are investing into your policy. Now, this is a 55-year-old female. For most of my 55-year-olds, what we want to do is we want to do either a 10-year plan or a 15-year plan. So we might do $10,000 a year for 10 years or $10,000 a year for 15 years. Might do 15 years if we are really far behind and we're trying to get started with our savings. But look what happens at the end of our investment period. We invest from 55 to 69. That's 15 years of investment into the policy. We're looking at the policy with the maximum death benefit. Okay, we started it with the maximum death benefit. Look what happens over time. I'm gonna move my screen over here. By the age of 69, this client would have invested $140,000 into the policy. Now look at what our savings account balance is at the end of 15 years. $150,000 is our savings balance approximately. Now, remember, this is the one with the highest death benefit. But remember, we're going to want to reduce that death benefit to the lowest that we can possibly have it based on our age and the amount of money that we're putting into the policy. So let's jump over to the policy setup that has the minimum death benefit. Look at what our savings account balance is. $196,000. Okay, so from 150 to almost 200,000, that is a 33% difference in the amount of savings that we accumulate in the policy over the 15 years that we are investing into the policy. So this is what I meant when I told you all that we just can't get an infinite banking policy. Yeah, we have the savings in there. We have all of the stuff. We got the different savings account options if we're using our IUL, or if you're using a whole life policy, you're getting dividends. But the amount of growth you're going to get on that savings depends on how the death benefit is on the front end. And so looking at this, we have about a third more in savings because we started our policy with the minimum death benefit. Now, this is not the end, because what is going to happen is when you're investing into your policy over a period of time, you're going to notice the total value of the contract will increase. Even though you have reduced the death benefit, the insurance company is going to classify the savings account and the death benefit as one sum. So what you can do in later years, you can reduce your death benefit again. So you're going to reduce it when you start it. Then once you get out to 15 or 20 years out, maybe when it's time for you to retire and you want to start taking money out of your contract, you'll want to reduce your death benefit again. Now, you notice I'm saying a lot about reducing death benefit. You can make all these changes to your plan because of what? It is an indexed universal life policy. If you have a whole life policy, you're going to be limited in the amount of changes you can make to that policy over a 10 or 15 year period. So this again is just a visualization of how the death benefit that you start with impacts both the growth and the income potential. Because look at our income. This is what we can take out of the policy on an annual basis in the 15th year, $13,818 starting in the 15th year, with the plan that has the higher death benefit jumping over to the plan with the minimum death benefit. Look, our income now jumps from $13,000 to $19,000, almost a 50% increase, approximately a 50% increase in the amount of tax-free income that you can pull out of your indexed universal life policy that you're using as your bank. All right, so now you realize the importance of structuring your policy correctly on the front end, meaning adjusting that death benefit on the front end, and then in later years, adjusting your death benefit a second time. Now, in some subsequent lessons in this infinite banking discussion, I'm going to go over some of the ways that you can take money out of the policy and the income tax implications of how you take money out of the policy. We're also going to cover some of the other finer details. Again, if you're going to start the infinite banking process, you need to be fully educated on all of the features, the benefits, the costs, and that is exactly what we're going to do here at the Black Wealth Company. So one of the things I notice a lot of in our community and even in general with people is people will not take the time to actually educate themselves. The first thing they do is they'll jump up and say something is a scam. Well, you read someone's comment, maybe even below this video or wherever, oh, well, you shouldn't invest in insurance. Okay, stop. The first thing you need to ask that person is, do you know anything about adjusting the death benefit? 99 times out of 100, they're not going to know anything about what you're talking about, right? And that is exactly what we're talking about here, is empowering our community so that we can be confident in the decisions that we're making. You can be making the best decision in the world, but if you're not confident in the decision that you're making, you're not going to ever be able to fully maximize the benefits of the decision that you're making. Again, infinite banking is a powerful, powerful strategy that can help people in our community who usually don't have as much saved as their white counterparts be able to start saving in a way that will help close that wealth gap and also provide a framework that you can put money in consistently, and then you can set up something like this for your kids, your grandkids. And this was a 55-year-old female I just showed you all that could take almost $20,000 a year out of her insurance policy, and she started at 55. Imagine starting something like this at 30, at 40, how much additional wealth you could accumulate, how that could help supplement your retirement income. All right. So again, we've just gone over the features of the death benefit and how you can make changes to the death benefit to improve the savings growth potential. If you are interested in a consultation, you want to get started with your infinite banking policy, you want us to guide you through this process, this is what we do at the Black Wealth Company. We help Black families all over the United States establish infinite banking policies, establish life insurance as an investment, and use their insurance policies to create tax-free income and also to grow their wealth outside of their retirement account. Now, in some other videos, again, we're going to keep going down this rabbit hole. I'm going to show you all how you can leverage your insurance policy to buy real estate. I'm also going to show you a very simple strategy that I developed that's going to allow you to leverage your life insurance, your cash value life insurance, to receive income tax deductions. You can receive very large income tax deductions from the money that you take out of your infinite banking policy if you follow the strategy that I'm going to teach you. You got to stay tuned. Y'all got to stay tuned. All right. Thank you again for watching. This is Jerry Gorton, President and CEO of the Black Wealth Company, where Black Wealth is our business.